To our first conversation now, let's look at Nigeria's foreign direct investment. We see there was a decline for the second quarter of 2024, dropped about $29.83 million, marking the lowest level recorded based on available data. That's up to about 2013. Well, joining us now to analyze this, we have Dr. Josh Bamfo, partner head Transfer Pricing and Economic Advisory at Anderson, Nigeria. Joining me right here in the studio. It's great to have you.
Thanks for having me.
Yeah, so much happening, at this time. And, we did see the central bank governor, saying that currency devaluation, currency weakness is an opportunity, for exports. And I'm wondering, is it also an opportunity for FDI?
No.
Oh.
So, yeah, first and foremost, it's true that generally when you have a weak currency, it makes your exported products relatively cheap on the international market. And all other factors remain the same. There will be increased demand for your products. And that's the reason why export-oriented countries such as Japan and China tend to have relatively weaker currencies because they're export-oriented in nature. But the same argument can be flipped the other way. You take a country like UK, they are very proud that the pound is strong. In fact, the weakening of the pound can actually cause, the career of a prime minister, which one lost. So you need to look at where you are as a country before you take such a policy prescription. Yes, over time, you might aspire to become export-oriented. But today, we are import-dependent. So you cannot weaken now when you are import-dependent. It will come with unintended significant consequences, and that's what we are facing today. If you look at the relationship between exchange rate and foreign direct investment as an example, if I'm a foreign investor and I want to invest in Nigeria, FDI means that I'm going to invest in long-term projects, like setting up a business, manufacturing plant. So I have to be able to project into the future whether I'm going to be profitable. And secondly, whether when I'm repatriating my dividends, which will be converted from naira to dollars, I'm going to get enough. So if you have a fast weakening currency, how would that make it attractive to me? That is actually risk, right? And that is the reason why, part of the reason why we've seen a sharp decline in terms of FDI from quarter one, which was around 119 million to 29.8 million quarter two. Now, to make it even more clear or explicit, compare it to when Nigeria was doing very well. That was the pre-2016 recession period. If you take 2011 as an example, the total FDI was about 84 billion US dollars. Quarter two this year, we've done 29.8. If we average the same amount for the whole year, that will be around 120 million. You are not even near 1 billion, let alone 8.4 billion. So really, the macroeconomic instability that we are facing, where the three key markets, market for goods and services, prices are already high. Inflation is over 32%. If you go to the market for funds, interest rates are already high. Monetary policy rate today is around 27.25. Cost of borrowing is just too expensive. You go to the market of forex, which is measured by exchange rate. We've seen a rapid depreciation of the exchange rate. If you compare it from the beginning of the year, it's about 40%. You go back to May 2023, a year just before the new administration took over, it's over 200% depreciation. So there's clear macroeconomic instability. Investors cannot predict with certainty how they're going to make their returns. Risk is too high, so FDI goes down.
And, definitely looking at the picture you just painted now with the currency, is it safe to say the naira, weakening is the root cause of all the high prices most of us are suffering now when it comes to sensitive products like petrol and food prices?
Exactly. So for me, when I look at how the Central Bank of Nigeria is trying to address its number one mandate, which is bringing down inflation, because its number one mandate is to bring price stability. And they have focused almost exclusively on interest rates to combat it. Now, what that assumes is that the major driver for inflation is on the demand side. That means that there's excess liquidity and people are demanding limited goods and services and putting pressure on price of goods and services. But when we look at it, that is part of the story because of the ways and means, fund releases back then. But they've already mopped up a significant portion of those liquidity. We know that monetary policy rate is at an all-time high. We know that cash reserve required ratio is around 50%. That means banks cannot make as much loans and all that. Now, the other part that they've actually been oblivious of or not focused on is the exchange rate element, which also falls under the Central Bank of Nigeria. Now, think of it this way. Under the current administration, two major policies were implemented. One was the removal of fuel subsidy, which means that any cushioning that would, help mitigate the huge fuel prices has been taken away. The second is the liberalization of the foreign exchange market from a fixed exchange rate regime to a floating exchange rate regime. And what we saw was a fast depreciation of the currency under this new regime, the floating exchange rate regime. Now, we import our fuel products. We export crude and import our fuel products. So what is contributing to the high fuel prices at the pumps? It's more of the fact that we have a weakened naira than even the removal of the fuel subsidy. Because anytime it weakens, the cost of importing that fuel product goes up.
So what if it was fuel subsidy is gone, but currency management stays?
At least the impact wouldn't have been that significant, right? So if we're still in a fixed exchange rate regime, what used to happen is that under the previous administration, you will be converting a naira to a dollar at 450. A dollar will be equivalent to around 450. So your import cost will not be as much. So that will not be reflective as much in terms of the price at the pump. But this time around, you've taken fuel subsidy, which was absorbing part of the shock, and also floated the exchange rate, which has actually depreciated by almost 200%. So your price would have gone up by almost a similar percentage.
But do you think this government would have been able to defend the 450 naira to the dollar?
No, not necessarily. So we all knew that it wasn't sustainable. And I'm not an advocate for a fixed exchange rate regime. Everything has its pros and cons. In the short term, it served a particular purpose. The previous, President Buhari was so high on, he was advised by IMF, World Bank, hey, you cannot sustain this, but he felt it was going to hurt, the poor folks. So he said, hey, keep it at that. As long as it's not, we can relieve the average Nigerian, we're going to keep it. But it's not sustainable, and we all agree about that. But you needed to look at the timing of the implementation of the policy. At the time that we're about to implement these policies, inflation rate was already above 22%. So we already had a high inflation rate. So even if we were going to remove, the fuel subsidy, you couldn't do that in addition to floating of the exchange rate. You understand me? If you're going to do that, you have to manage that float. So there are three types of foreign exchange rate regimes. We are looking at the two extremes. One is a fixed exchange rate regime, which the previous administration implemented, which has its own problems. The other extreme is a floating exchange rate regime, where you are saying, I'm allowing the demand and supply forces to determine the price, willing buyer, willing seller. And that leads to this weakening. There's one in the middle called the managed float, where you agree to a reasonable rate within some range, and you manage it and keep it at that point. Because the problem I see with the current situation is this. There's this assumption based on theory that as the price of exchange rate goes up, it will price out some individuals and some businesses who used to demand for those forex, for those who used to take their kids to school in, let's say, UK or the US. All of a sudden, it becomes too expensive. So you might tell your child, hey, come home and go to school in Ikoyi, for example, right? If you used to go for medical checkups, all right, now it becomes too expensive to buy a dollar. You might cease not to go to UK or US, So it prices out some people. But over time, it's supposed to stabilize. The quantity demanded and the quantity supply is supposed to stabilize, based on the assumption that all other factors remain the same. But factors don't remain the same in real life. We know that there's more speculative demand today that has not been factored in this whole argument. So what we've seen is that, yes, we've seen a high depreciation. Yes, we've seen CBN supply more forex. But still, it keeps depreciating. What is happening? Anytime there's a FAC release, all right, Federal Account Allocation Committee releases funds, we see a correlation between those FAC releases to the states and the demand for forex. And then we see a depreciation, which means that anybody who has excess naira, what are you going to do? You're going to buy dollars because it's depreciating. So it becomes, the naira is depreciating, it's getting weaker. So dollar becomes a store of value. So no matter how the price goes up, people are going to demand more. Not because they have a need for dollar, but because now it becomes a store of value. So there's a need to take out that speculative activity by crashing the dollar to a reasonable period and level and keep it at that point. If I know that I'm going to get dollars at some particular price and it's not going to depreciate over time, I'm not going to rush and go buy dollars.
So there's no need to go,
no need.
not to go storing. But let's look at foreign direct investment. Now we know the chief executive officer of J.P. Morgan, Mr. Jamie Dimon, he advised countries like, including Nigeria, that sort out issues when it comes to legal issues, regulatory framework, and all of that. That way, we're going to be piling money, into the country. And I'm wondering, is it that easy for a country like Nigeria?
So there are multiplicity of factors that makes a country attractive for foreign direct investment, right? And if we didn't have this, macroeconomic instability that I just talked about, then issues like, protection of property rights, legal framework, institutions, all these factors become very important. Infrastructural development, because if I'm going to invest in manufacturing and there's gridlock at the ports, it's going to take me months before I move my stuff from the ports to the warehouse. That becomes a problem. I'll compare Nigeria versus another country such as Ghana, right? And say, hey, can I do the manufacturing there and still access Nigeria's large, big economy, which is the competitive advantage of Nigeria. So there are a number of things that need to be done. For example, another example is the energy cost, power, right? If I'm going to go into manufacturing, power cost is very important. Do we have, more consistent power supply, and is it affordable or reasonable so it doesn't eat into my profitability? So there are numerous factors that makes a destination attractive for foreign direct investment. Nigeria has always had that competitive advantage of being the largest economy, large population size. So for consumer markets, definitely you want to come near the consumers, right? And that's the reason Nigeria was always an attractive place. But until we get the economy to be stable, all right, it erodes all the competitive advantages that we have. You understand me? It's just like an economy can only take off if it's pretty stable, right? And now we are bleeding. We are bleeding in all areas. Because even if I come and invest, and the exchange rate was, pretty stable, I'll still think about the cost of borrowing, which is interest rate, because I'll need something for my working capital. I cannot be injecting, because I'll inject equity, but I expect to be able to source funds for my day-to-day running of my business. But if monetary policy rate is already around 27.25, that means the prime lending rate is going to be over 30%. How much am I expecting to make in terms of profitability to be borrowing at such a rate? So all these things have to be stabilized because they are not normal rates. We know that they are up there because of a problem, trying to address inflation. So inflation has to come down, interest rate has to come down, exchange rate has to stabilize. Until then, we have instability, and it's not attractive to foreign direct investors.
And we need to get more attractive.
Exactly, we really need to.
At this point. Well, definitely so much to unpack there. I want to thank you so much, Mr. Josh Bamfo, partner, head transfer pricing, economic advisory, Anderson, Nigeria. It was great having your perspective. Always great,
very much.
Having your perspective.
I appreciate it.
All right, we'll take a break now. When we come back, we're going to head straight to the markets. That's in a moment. Just stay with us.
Thank you.